Welcome to this breakout, Demystifying Impact Valuation. I'm Sebastian Welisieco. I act as Chief Policy Officer of the GSG, and I'm here joined by this amazing group of friends and colleagues. I want to say something first, like a full disclaimer. This is a master class, and I was thinking, what is a master class? Well, master it is, because these guys are masters in what they do, and they really master their field. Is it a class? I don't know. I didn't want it to be a class. I wanted to be a session amongst colleagues and to be very interactive. So I said to them, no slides. Don't you dare show a slide. But then they played like a bit of trick on me, and they sent me this slide deck that was amazing. So I said, well, maybe I will allow you to use slides responsibly when needed. And if it's too much slides, I will tell you too much slides. But it's amazing the material they brought. To me, they are Andrea, Dan, Tobias, but formally, I'm super happy to introduce Andrea Serra. Is the Chief Market Development Officer of the International Foundation for Valuing Impacts. Hi, Andrea.
Hello.
How are you doing?
I'm doing
Happy
great.
to be here?
Sorry?
Happy to be here in Malaga?
Extremely happy to be here. First time in Malaga,
Where did you come from?
Puerto Rico.
Very nice. Dan Osaski, Chief Research Officer at the same institution, International Foundation for Valuing Impacts. Welcome, Dan.
Thank you. Also happy to be here, but a little jet-lagged.
How are you feeling? Where did you come from?
Philadelphia, Pennsylvania.
Philadelphia, it's a long way.
US. Yeah.
Long way. Well, thank you for being here. And Tobias Wiltner. Tobias is the Global Head of Sustainable Finance and Standard Setting at the Value Balancing Alliance, the VBA. Thank you, Tobias, for being here.
Thank you. It's a pleasure.
Where did you come from, Tobias?
Actually, Nuremberg, so Bavaria. Not
Okay.
that far.
Very good. Not that far. Not that
Could have
far.
almost walked.
Okay, amazing. Thank you for being with us. So I would say first, before we start this impact valuation, then we'll talk about impact valuation, we'll talk about impact accounting. And I guess, all of you, some of you will be experts and some of you will be curious. Who would say, I'm an expert? Raise your hand in this field. I'm curious. That's what we want, curious and experts, and then engage in a conversation. I'm also curious. I've been working in this field for a lot of time, and I still think I don't understand anything. I'm part of the technical committee of the IFBI. I have that honor. I feel that every session, every material, I learn a bit more, but it's tough, it's hard. It's intimidating as well. So hopefully today we come out of this session getting to know the basics and being more interested and versed in this very important field for the future of the global economy. So today I said to the guys, if we all here live with a fair panorama of four things, I think we can say we're fine. And in the end, I will ask you, did you get those four outcomes? What is impact valuation, roughly? What is impact valuation? What is impact accounting? Why should we care about that? How do you do it? And what next in the field? If we go out of these 55 minutes, more or less, kind of conscious of that, I would say big success. And we deserve a drink tonight. And whoever feels that they don't achieve the goals, they stay here for the rest of the afternoon, analyzing the slide deck, and they have a private lesson with them until they get the basics, okay? I will like to start with Dan. Dan, you're allowed to use slides just because you're very good slides. And I would like for you to kick us off saying this very simple and very complex question. What is impact valuation? Should we call it impact valuation? Should we call it something else? And why should we care about this?
Thank you, Seb. I feel like there's so much in your intro that I should be responding to right now before even answering that question. It feels like there's a lot of pressure on this session, saying that's going to be the best one. And then the second one is I think we need to have a conversation about your future on the technical committee when you go on record telling everyone that you are confused by this work. We can take this being an important conversation for you for the next steps on that. But thank you for hosting this, and hello, everybody. There's a bit of a transition that we're gonna have in this conversation that I want to acknowledge at the outset to what you were just sharing around terminology. The title of this session is about impact valuation. You're going to hear us talk quite frequently about impact accounting. Those are very related concepts, but I think ultimately as we tease it out, you're going to see where there are some key distinctions. We are going to be talking a bit about impact accounting as an overall framework to think about this space and this work, and particularly the methodology and the ideas that the organizations that are up on the stage have been promoting and working on developing. Impact valuation is an important and essential component to impact accounting. And I also want to acknowledge at the outset that there are many different approaches to impact valuation. And again, we're going to be focused on one particular approach, and why I think, again, as we tease it out, we're going to see why we believe this is a particularly important and necessary function for the future of our economy. And so I want to set things up with a tie-in to some of the conversations that actually began in the plenary this morning, because I think there was also a lot of references to impact accounting as well as the future of reporting on sustainability metrics and things like that. And I think there's two sort of conceptual historical movements that we can look to as it relates to impact accounting to understand where we sit in contrast to them. The first is the world of financial accounting, which has been in development for over hundreds of years. Even as Emmanuel Faber recognized this morning, there is still a great deal of estimation in that work. They're hundreds of years ahead of this space of impact measurement and impact accounting, and it's accept it and adopt it as just a necessary norm for the way that our markets and our businesses function. At the same time, that has always been focused by its name on financial performance. And so we, in the impact accounting and valuation space, acknowledge that it is by definition incomplete. It is only focusing on that financial performance. And as a result of that focus on financial performance, it leads to inefficient decision making because it is not taking into account the actual social and environmental impacts of an entity or of a portfolio, et cetera. An important development in response to that has been the world of ESG metrics and mandatory reporting disclosures. Those types of ESG metrics are frequently focused on inputs or activities or outputs of an entity, but are frequently challenged to actually move from those topics of measurement to actual outcomes and impact. They are also difficult to compare across entities and across impact topics. And as a result, they are similarly limited in decision usefulness for many kinds of decision makers, whether it's managers within an organization, boards of directors, or investment decision makers. This is backed up by some studies of people in this space. PwC has conducted some surveys, and 87% of investors think that corporate reporting has its own limitations currently because it includes things like greenwashing. 66% of those investors want information about impact, which could arguably just be about this baseline of sustainability reporting metrics, but actually 66% of those are actually seeking the ability to understand those types of impacts in monetary terms, so understanding the monetary value of that impact. And so what does that mean? What is impact accounting? Impact accounting is basically the framework that is aligned with financial accounting, but is measuring the outcomes on society and the environment of an enterprise in our framework defined in monetary terms to allow that comparability to financial performance and across topics. This is a really, really messy slide. Seb has said it's really great, and I know we don't have that much time to go into it. So I just want to give a bit of an overview around the context of this so we can perhaps in the Q&A dive into it in a little bit more detail. But essentially, the way that you can think about impact accounting working is it is building off of and aligned with the sustainability reporting metrics that are being conducted already. A company is using assessments to identify what are material topics for their particular context, and then are collecting data about those topics. And then in the impact accounting framework, they are taking that data through what we refer to as impact pathways, where we're able to transfer that data into the particular outcomes that are being produced and how to actually quantify and measure those, again, in monetary terms to allow for a conclusion at the end that is what we refer to as impact information that allows this type of decision making where you're able to assess different trade-offs and the context of actual results that a company is working on. And so there are a few different types of preparers of impact accounts or impact accounting. That can include the corporate entity themselves, much like an internal management function. But we've also seen plenty of examples, and I think we'll be able to dive into this also in a little bit more detail, where others around that corporate entity are able to leverage the data that already exists about companies and perform similar impact accounting functions. And so you can imagine an investor doing this for their portfolio companies and not needing to have it come from the internal entity themselves. And then those are the preparers of the impact accounts, but ultimately we recognize key users of these impact accounts as distinct from the preparers themselves. That could be internal managers of an organization, but again, similar to the reporting landscape, building on top of that, this could be useful for investors, lenders, other creditors of an organization, and ultimately a broader set of stakeholders of a business at large. All of this leads to what we see as the concluding important component of what we're all trying to achieve, which is an integrated impact, profit, and loss statement, where once an organization is doing this work around impact accounting, you are able to assess, similar to a balance sheet or other financial statements that a company is producing, very clear, concise, organized, accessible, verifiable, analyzable, numeric outputs of a company's overall performance on social and environmental impact to really get into these details and allow stakeholders to not only have the understanding about how a company is performing, but also to actually lead that to decision making. Ronnie this morning shared a few examples about some of the key insights when we look at publicly traded companies and the data that they're already producing. When you run them through impact accounts, you're able to actually see where there might be both results that you could expect of certain companies and their reputations, but also potentially new insights to really challenge what might be some frequent assumptions about companies' both positive and negative impacts and what it actually looks like in a more rigorous, consistent, standardized methodology.
Dan, so you touched on so many important points. So essentially, you started saying that we take information we take decisions with incomplete information, because essentially we know about the left-hand side column, which is the financial information. And as humans, we came to accept that for many decades. And we invest in company A or company B, only knowing their net profit or whatever, or their sales, or our expectations of their performance solely in financial terms. And what you're doing here is essentially changing the DNA of capitalism, and I'm not exaggerating, because you're allowing investors, companies that invest in other companies, and consumers that want to know, who am I buying from? Is this product, or if I'm investing in this company, these $100 of net profit, were they achieved regenerating a natural system, or were they achieved destroying a natural system? Were they achieved with a diverse workforce or not, or excluding people from the workforce? So that's one step that you said, the issue of complete information, but you went, I think, 2 steps beyond what Mr. Faber was saying in the morning, because you talked about I would say, you didn't say in these terms, like double materiality impacts not only on the enterprise value, but you talked about impacts on all stakeholders. If you noted today, Mr. Faber, very carefully and very scientifically, didn't use the word impact. He used the word of sustainability risks, because he was talking about things pertaining to enterprise, and you went beyond. He said impact on all stakeholders. So that's one step further than the mere sustainability reporting. But then you said, I can't compare. It's not easy to compare, I say, tons of carbon or hectares of wood protected with jobs created or diversity in the workforce. And you said we need a single unit, which in your case you chose it to be a monetary unit, to then be able to arrive to that final outcome. Will it change the profession of auditing? So like someone today that works in KPMG or EY, in a few years, will they have to audit these accounts the same way they've been auditing the other accounts for ages? What do you think?
Yeah, I think the vision is yes. In that when we're able to develop this methodology in a rigorous way, consistent with those principles of financial accounting, the future opens up the opportunity for us to think of it much like financial accounting in many other ways. And that includes expectations around verification, embedding it within organizational management practices, even when we think about the future of what business education can be for MBA students and things like that. Absolutely. There is one point that I do want to quickly acknowledge to what you were sharing around that convergence around a single number. That is also arguably the most controversial part of this work, in that there are important questions to be had around how you're able to compare different types of impacts and what that means for the ability to trade off. And I think even we as those organizations who are trying to lead that work need to acknowledge the risks that exist in that. And when we are producing these impact, profit, and loss statements and things like that, there will need to be important considerations to acknowledge each of those impacts on their own in a way that isn't just aggregated at a top level, to acknowledge that you can't really just net out your overall impact. You need to respect very specific expectations, norms, rights, and thresholds within particular stakeholder groups and areas of impact.
It's very sensitive because that information, well managed, is very powerful. With a bias, it's very dangerous, I guess, and some people will be worried about that, the external critiques of this. Well, we'll come back to all of this, and thank you for, are we more or less okay with what is impact accounting / valuation, and why should we care about it? I mean, do you care about the future of capitalism? Otherwise, you should be in the other event. It's one about SMEs and I don't know what. I mean, maybe you got the wrong side. So I will assume you care about the future of capitalism. So I would say thank you, Dan, for sorting us out. But then it comes the question. So maybe you were saying, well, these guys are absolute lunatics. It all sounds very nice. Theoretically, they will change the world. And we will sing all together, Heal the World by Michael Jackson with Ronnie at the end of the methodology. But it's impossible. And some of you may be thinking it's impossible. But Tobias, you've been doing it. You've been implementing this. So there are companies, I assume, that have been trying this out. How does it work, Tobias?
So yes, we found a few other lunatics over the past few years. So what I'm trying to explain to you now is basically how impact accounting or measurement and valuation looks like in practice, how it already is starting to affect internal decision-making by corporates, and then maybe most importantly, or very importantly at the moment, how this relates to a regulatory environment. I mean, we heard Mr. Faber, standard setting, sustainability reporting, so how this fits in with a changing regulatory environment for corporates, which means a lot of burdens additionally to financial reporting. So just a bit context, I'm not going to explain this in detail. So we do this in practice since 2019, putting impact accounting frameworks, impact valuation and measurement into practice with these largely well-known international companies. So we're going into the 4th piloting round now, and they are really putting it into practice. And without getting a little bit too much ahead of myself, I think there are 2 big trends we can see. One trend is that impact accounting, so measurement and valuation, is really starting to have an impact on internal decision making, and that like if a company pilots something for 3-4 years, they better, I guess, start thinking about, okay, can I use this information internally? So we see this happening. And the other thing is, and that started at the end of 2022, beginning of 2023, is that obviously changing regulatory environments, especially reporting standards of the EFRAGs, CSRD, ISSB, has an increasing impact also as like our members or the members asking, okay, so how can I fit this within these reporting standards? So just to demystify a little bit what this is all about. So there's always an impact pathway, what we call. So we would have our impacts on the one side. This is something that companies already measure, their energy use, so they already know about this. Then they will start, and that's basically what regulation will ask them, especially in Europe mandatorily, to measure their direct outputs, so your carbon emissions, and to some extent also the changes that result from them. But regulation will not go as far to put this in a contextualized context. So what does this actually mean? And the question then remains, can I use a physical KPI like a ton of CO2, a cubic meter of water really for changing internal decision-making or decision-making as a whole? And this is basically where the VBA IFVI methodology comes into place and where impact accounting, so measurement and valuation, has a very important role to play to basically build on what many corporations, especially in Europe now, will need to report anyway, mandatorily, and put that in context and actually make use of this reporting data. And that's also an important part for the financial markets, who will soon have access to a lot of, in this case, key performance indicators that are disclosed within a report. But the question arises, okay, so what do I next with it? How does that affect my decision making? This is how it then looks really in practice. Obviously, it's the simplest example to be chosen. So it's CO2 emissions. So in that case, you would know your tons of CO2 emitted. You would get this from a CSRD report, an upcoming ISSB report or something. But then if you really add a valuation factor, so you value these, and that's where you are able to contextualize it. Let's say those emissions are in a different region, they have a different time frame attached to them. Then you can actually put this in a well-known metric, like in this case euros or US dollars, and feed that into established internal decisions making, like cost benefits analysis and others. So this is how it looks like for our companies piloting in practice. And now just a few cases, and I will not go through all of them, but what you will see on the left side from Holcim, this was one case from actually the first piloting round. And obviously you might know Holcim is quite a big company, so an investment, an R&D investment of 1 million Swiss francs is not really material to a Holcim. So this just gives you a bit of an understanding. This was piloting round 1. They internally tried this on a very small project and decided it's worthwhile from an impact perspective to go forward with this project. Pilot round 2, in this case Bosch, they already compared the impact of different packaging material for internal use and decided, well, from an impact and from a financial perspective, it might make sense to change packaging due to impact accounting or the additional information we have. So that was pilot 2, and pilot 3 now, which we just concluded, is a case from Bayer in that case, Bayer UK. So they really thought about, okay, we might change the vial size of one of our medicines. What kind of impact does this have on, in that case, CO2 emissions or also social benefits? So in that case, because it's the UK, so how might it decrease the burden already existing on NHS? And they decided to go for an increased vial size, mainly because of an improved impact profile. And what's happening now, and this should just outline the process that companies are going through once they start thinking about impact. In the piloting round 4 that just started, they are really trying to take an even more holistic picture, also considering the impact of such a decision on other aspects like natural resource use, water use, and others. And this is conceptual for now, but with this kind of decision, they are at a stage now to roll this out for much broader decision making within all of their product innovations. So what this is meant to show you is that impact accounting takes some time from your first piloting round or from your first attempt to implement it, but at the end of the day, it is really useful for decision making as outlined by quite a few of our companies.
So what it's telling us is that these companies that today, in 2023, they are not mandated to disclose sustainability because it's not yet mandatory.
Exactly.
Some of them are going, 2 generations ahead, and they are voluntarily, assuming the scrutiny of going through this methodology that exposes a lot of information and assigns some monetary value. Have you, and you don't have to say the case, of course, but have you found a case where you were working at a company and the company really didn't like what they found and they said, wait, cancel the pilot until we get our act together?
there are a few cases where obviously the result isn't really what you hoped for. But I think, as Dan mentioned, there's a lot of uncertainty also in the way that the valuation factors or valuation coefficients are calculated. So there is a lot of discussion that you then need to have internally, because impact accounting is still at the beginning. So it's just at the beginning, and there's a lot of, and that's the importance then of like really discussing it with corporations and members to understand where your impact might come from. You're absolutely right. They are not mandated, or they won't disclose this information now, and regulation will only tell them to disclose the physical KPI, so your cubic meter of water or your ton of CO2. But what's really interesting, that even the companies that might not like the result, they actually come back having thought about this and engaging in a discussion to see where this is coming from.
To improve, yeah. And I think the case that you're showing, the cases you're showing today are people who came to you and said, well, I want to work with you. But today, Ronnie mentioned cases of companies that didn't come to you. So the numbers that Ronnie talked about today about Amazon and stuff, did you calculate that using public information from those companies, and then you plugged in a monetary value?
That's right. And so the data that was reported there was actually from a previous incarnation of the work that we're doing now, which was the Impact Weighted Accounts Initiative, which was housed at the Harvard Business School and was more of an academic proof of concept exercise around impact accounting. And it was leveraging existing publicly available data about companies and putting them through these impact pathways to show hypothetical versions of what this impact accounting could look like.
And didn't you get like a phone call down, we're going to kill you, or we know where you live? Because you were saying strong things about these companies in public. No one got angry at you? At you, the group, not at you, Dan, at the organization.
Yeah, we were only saying things that were already out there. We were just putting a different lens and a really rigorous methodology.
And change your mobile number, and change your phones and moving houses. Yeah, good, very good. Interesting stuff. I know. I hope that people are getting how transformational this is, because we are getting to know things about companies that we have no idea about. And one thing that very recently we did an event with this lovely group at the GSG. We did a webinar, and I had no idea about this. I've been following the work, but I didn't know about this particular case. But I was amazed to see, as a former public officer, and I was amazed to see that these principles can be applied also to public sector activity. In the public sector, it happens more or less the same. I tell you the story. I was Vice Minister of Development in my country, in Argentina, manages a very big budget. But a government like that basically purchases inputs. And you spend your whole budget on inputs. And you're accountable to society essentially on inputs. And a good politician or a good public officer is the one that depletes all the fund in the fiscal year. And if you're underperforming, it's because you didn't spend all the money. Now, if your spending achieved good outcomes, better outcomes in comparison to any standard, no one cares. I mean, you're only judged by your ability to spend money. That's how you see many countries, Q4, people rush to spend money, because if they don't spend the next year, they don't get the same budget, which is a terrible incentive for a politician or a policymaker. So let alone reporting 1.0 sustainability metrics, it would be a miracle. And there are people working on that. But you told us last week, and I would like you to share a bit of that you went ahead and you worked with a city to take this further and test this methodology in a public sector office. Mm-hmm. How was that?
That's correct. Can you hear me okay? Yeah, wasn't sure if this was working. That's correct, and as Tobias has just flagged, a lot of this work has been piloted mostly by companies and by investors, but for me, one of the most powerful and interesting case studies is one that occurred while we were housed at the Harvard Business School through the Impact Weighted Accounts Initiative. We worked very closely with the Fresno County Economic Development Corporation. For those of you who don't know, Fresno County is a county within the state of California in the United States, and like many other economic development corporations, they focus on attracting and retaining businesses to that particular county for job creation and for economic growth. And as many of you know, cities tend to compete with one another for businesses. And even though there are cities that have severe issues like unemployment, racial disparities, economic inequality, air pollution, and other environmental issues, they end up still giving huge sums in tax incentives and grants to multinational companies to come settle in that region. And I think that's been pretty much the thinking so far. The status quo is a race to the bottom, and how can we squeeze every last dollar out of communities with really no way of actually measuring what is the impact that these companies are having locally on these communities. And so Fresno EDC reached out to the Impact Weighted Accounts Initiative with this idea of how can we change this paradigm, this way of thinking? How can we better realign incentives so that companies benefit from coming to our county, but we can also measure that impact in terms of employment and in terms of other social and environmental impacts. So Fresno EDC actually applied the IWA, back then called IWA, now Impact Accounting methodology, into their RFP process, and also integrated it into a very innovative corporate scorecard of sorts that they evaluated companies on their environmental, employment, and social impact on an annual basis. And instead of agreeing, let's say, on a tax incentive upfront with a company, you did it in a way that it was dependent on that annual evaluation. So that was really powerful tool. Since then, they have continued to expand the use of impact accounting, and in fact are now moving forward to using it for a whole variety of use cases, which I hope to be able to present next time around. So for me, that's my favorite case study.
And this is a case of, in the companies that Tobias was referring to, I guess that in some way they opted to be more accountable to society, to their shareholders, stakeholders, voluntarily. And this government chose the same. I mean, they chose to be more accountable to their citizens. And in many ways, I mean, I say this, I'm an economist, and I do a lot of, macroeconomics and stuff. The effectiveness of fiscal incentives, it's kind of an act of faith, and the evidence is so blurred. So you can say anything. I mean, if you want to make it work, but this brings a whole new layer of transparency. This particular fiscal incentive result in the benefit of the community or not? And what is this? I mean, give us a number, give us something of that case.
Specific numbers, I don't think they've disclosed so far. I do know that they had previously a $50 million grant for e-commerce businesses settling into Fresno County, and it had no teeth. Right? They had no way of actually seeing how those $50 million were being used. And that initially was the reason they came to us, because they couldn't do it for that case around. I don't have numbers for the...
Very good. Well, but I mean, the good public officer, the good CEO will want this information to make better decisions, not only to be more accountable. Very good.
Absolutely.
As this session is so wonderful, so we have, I want to save a few minutes at the end, for you guys to tell us what next and how to engage with the amazing work you do. But we have a bit of time, and I promised we wanted this to be as interactive as possible. And I don't know, many of you raised your hands saying that you were curious. So if everything that was said here didn't spark a layer of curiosity in your inner selves, I don't know, again, you're in the wrong event. Are there any questions that people want to ask? I think there's a microphone somewhere there. I don't believe you if you say with no questions. There's a question there. And there's a question there, and then we have a colleague here, and then someone there. So we have three.
Everybody in the front row.
Let's take three questions. You, sir, if you want to introduce yourself, where you come from to this summit.
Sure. This is Ecmal Ayral. I'm from Istanbul. I have a question for Dan. Actually, on your presentation, there was this Excel sheet. Can you go back to that one?
Dan, they call you to their game.
I think they might need to put it back up. Yeah.
Actually, it's, yeah.
Tata, can you move it?
Yeah,
this one.
This is the one, yeah.
Yep.
Yeah. When you look at the natural ones, I mean, when you look at the items, so the best case scenario probably is the one in which those items will be zero. So is it possible to have a case where, we have positive values on those items? These are only deductions from the financial values.
Yep.
So Is
So-
it possible to add something onto that?
Yeah. So first of all, I want to just acknowledge for the full room. This is very much a sample, and this is actually something that was developed by a partner of ours, the Impact Institute and the Impact Economy Foundation. Did I hear a whoop whoop? There you go. Yeah. Hi. And so we just want to acknowledge and give that proper credit. For the most part, environmental impact, when you think about what that means for corporate entities, will always be negative. I could, and this could be a broader dialogue where you could perhaps explore what are regenerative versions of business models and solutions that could be tipping that into a positive restorative capacity. But for traditional businesses, I think it's fair to expect that the environmental line on an impact profit and loss statement will be overall negative, and it's about reducing the amount of what that negative is.
Okay, so I mean, if you use solar energy, for example, so would that add something to the financial values or just neutral?
Solar energy?
Yeah.
Yeah.
For example.
So if you're using solar energy, it would be reducing the negative.
Reducing the negative.
That's
nothing
correct.
else.
Yeah.
Thank you.
Yeah.
Thank you so much for your question, sir, and thank you for being here with us, all the way from Istanbul. Thank you for being in the summit. There was a question here. Can we pass on the mic to this colleague? If you want to introduce yourself, if you want to tell us where you came from.
Sure. Hi, everyone. Ornella Nicolacci with the Clean Energy Buyers Alliance in Washington, D.C. Thank you so much for the fun masterclass. Question, I know that you have methodologies specific to certain sectors and industries. Could you quickly walk us through your process for prioritizing what sectors you will develop new methodologies for, and how you choose companies to start a pilot? Thanks.
Sure. And are we taking questions one by one? Just want to make sure.
We can take the question one by one, yeah.
Yeah, okay. I'll respond to the first part of that, and then perhaps you two respond to the second part?
Yes.
Great. So we are in the midst of the development of our impact accounting methodology. There are going to be a few different components to the overall methodology. That includes a general methodology, which is setting cross-cutting principles and frameworks for the work. And then there will be topical methodologies, which will be things like greenhouse gas emissions, wages, that are intended to be cross-industry. There will still be contextualization within them, as Tobias mentioned, with things like value factors and the data collected, but the methodology themselves will be meant to be universal. And then there will be industry-specific methodologies that we do plan on developing. Those will be generally focused on the unique product impacts of an industry, because that's where we've identified there's really the need for these specific impact pathways to be further developed. And so that's just putting how we think about industry-specific development in context. We set our work plan for any given year with the support of our independent governing body, the Valuation Technical Practitioner Committee, and always look for feedback around what is that work plan. And so there's not only transparency, but also open to feedback about which ones we should be considering prioritizing. And I will leave it at that, but then I think there's also a question about the piloting nature, and you two can share.
Yeah. Tobias, do you want to go first?
Yeah, I think if I might just add from a purely practical point of view, I think until recently it was really for us about what's the interest of our members, where are our members like predominantly, where do they come from? So for us it was mobility and health, and that's because there was the biggest interest from members, and those are important sectors. But what we see now since the beginning of the year, and you might be aware of this whole discussion about materiality assessment and what is really material from a reporting standards point of view, so the ISSB and the EFRAGs. So we probably will see from a purely practical point of view more focus on sectors that will be, like sustainability and impacts will be very material too. And this will most likely also involve then obviously agriculture, energy, like the generally heavy impact industries. So, yeah.
And to further respond to your question around how we decide which companies to work with. So obviously the Value Balancing Alliance is a membership-based organization composed of an alliance of companies, so that's very straightforward. In our case, the majority of the corporate pilots that we did was before we became IFBI, and now obviously through our partnership with the Value Balancing Alliance, they really are kind of leading on the pilots with the companies. However, we do work with a lot of investors also at IFBI, and a lot of those investors are interested in piloting impact accounting for a selection of their portfolio companies. And so that's another way that we get interest from that as well. That's one avenue. And then the second avenue is we are getting a lot of interest from consulting firms around the world, not only the big traditional consulting firms, but also smaller ESG boutique consulting firms, including one in Spain that we're working with at the moment, who have a lot of clients that are interested in piloting impact accounting. And so hopefully those consulting firms can also become partners and advocates of our work.
Thank you for your question, and thank you for making it to Malaga to be here with us these days. There was another question there. Yeah.
Hello, thank you very much. Maria Herrero from Transcendent Consulting firm from Madrid, very short trip. I wanted to ask Tobias, you were saying that some companies were not happy with the results, but what we were talking about is that this exercise is an internal and external exercise. So I understand that they might not be happy or worried about the external, if you have to show it to stakeholders, but that is not mandatory today. So the opportunity now is that companies can do it voluntarily for the internal results, that they can better make better decisions and put light on things that they didn't know they were doing, both on the negative to improve and on the positive that maybe we're not telling the world about doing those positive effects. So what I meant to say, and if you could clarify, Tobias, is that when you say that companies might not be happy, doesn't mean that it was not a good exercise to do and show light that for the management team was very important to do. Thank you.
I think you're absolutely right. I think the first reaction if you receive a result that doesn't look that well is to basically say, well, this can't be right. So please recalculate, especially if you start in a topic like impact accounting where there's a lot of work, conceptual work still necessary, a lot of transparency. But then again, if that happens over 1 or 2 piloting rounds and the same, after discussion, the same result comes back, then exactly that process happens internally, that companies internally start thinking, I might actually be doing something wrong if those results are there. And the ones that I showed are just the ones that we are able to show outside. So there's a whole list of these case studies that won't be disclosed publicly, but they are used internally exactly for that reason. And I think sustainability reporting, the way it changes, will help to get a bit more transparency, but only to a certain limit. So I hope this answers the question.
Thank you, Maria. There's another question there, and if you have your, and there are 2 questions there. So 1, 2, 3, and I think we'll have time for those 3.
Hi, Beppe Zammarchi from Italy. I work for a bank. So my question to you is, and I'm thinking not with my asset manager hat on, but with my lender hat on. Are there any specific challenges for the banking sector that you see in the impact accounting? Because as I see it from my standpoint, we need a number of data points and a number of information from our customers that are sector specific, and what you're telling us is that they can be very tricky sector by sector. So if I come as a bank on the other side of the value chain, how far do you think we can go within our sector?
Who wants to tackle that one?
Excellent question.
I could go first.
Oh,
Yeah.
sure.
It's a great question. I think there's 2 things that I would share. One of which is it depends on the context of you as a lender and how how much engagement and control you have over those that you're lending to, right? That always is going to vary, whether there's a direct ask to be able to collect that information. And depending on your answer to that, obviously there are different challenges. I think as Tobias was referencing, everyone knows there are massive challenges around data in for any type of analysis around impact. There are a lot of organizations, most large companies now, who are reporting to some degree voluntarily, but they're inconsistent, they're kind of all over the place. The ISSB, CSRD, et cetera, are all working towards addressing that. But then even beyond those large publicly traded companies, there are massive challenges for SMEs and all of that. And so what I would largely say is, to some degree, the work that we are doing is just as limited and inherently challenged as what you're finding in your space. And it's important for all of us to collectively try to make sure that there is the right data regime in place to support any type of analysis, including impact accounting. And I'm optimistic, as Tobias said, that I think at least over the next few years, there will be significant improvements in that space. Exactly how much that improvement occurs and where, I think is in a lot of ways up to us to make sure that we try to support that.
Panel, you look amazing from here. I came to see you from here because you look lovely, and I came to be closer to our audience. So I made a new friend here. Edward has a question for you. Edward?
Yeah. Thanks so much. 2 questions. I'm Edward Isingoma from Pearl Capital Partners. We are an agri-fund management business out of Uganda. One, to what extent do you think, in terms of impact accounting, would pressure be on the entrepreneurs, especially down in Africa, like we saw when we had gears ratings, and the amount of time, the amount of stress it put on those entrepreneurs and businesses in terms of filling out 70-page questionnaires and things like that? To what extent is that being managed? And then the second one is, in terms of standards, I'm a chartered accountant by background. Who is setting those standards, and are those standards fit them all? Or are those standards being geographically cut across various geographies or various sizes of enterprises? Thank you.
Wait, these were 2 excellent questions. Let's take one more, and we respond to everything so we don't run out of time. Bear with us. Excellent questions, Edward, thank you. And there was a question here, right? I won't climb all these guys. They look very tough, so I don't want to have any trouble. You come.
Thank you. I also have 2, but you can choose one. What are the capabilities that companies should develop to do the impact accounting internally to make it scalable? And the second one is, what are the incentives that should be in place for companies to do impact accounting?
So what's your name? Where you from?
I'm from Chile, Mustakis Foundation. My name is Matias.
Gracias, Matias. There was one more? Someone had a pressing question? No, we are fine. Okay, so we have an excellent question on inclusivity and how we don't disentangle SMEs and we don't add yet one more layer of burden that we know what it means. Then there was a question of the integrity in the standard setting process, and now the question from our friend from Chile. Please, panel, illuminate us quickly so we can close.
I'm happy to take the first one quickly, the one around SMEs and entrepreneurs. I think that's a fantastic question and something that's definitely in our agenda. Again, because this is so early on and this is still very nascent, the bulk of the early adopters have been the large multinational companies that are well advanced in their thinking around sustainability and ESG and are already reporting quite a bit. And so I cannot say we have worked a lot with smaller businesses, or at least from, correct me if I'm wrong, because I was not at the Harvard Business School, but it is, so one of the things that, so I lead our market development team, which is really all about how do we translate the amazing research and methodologies that we are doing into useful guides for a variety of audiences. And one of those key audiences is exactly SMEs and entrepreneurs. We are hopefully going to come up with training modules and other materials to support that process and make it less onerous on the smaller businesses to be able to do this. Sorry that I don't have a better answer than that, but we're still at the very beginning of our work.
Very important. I assume a commitment as a member of the committee to push hard on that and give a hand.
Absolutely.
Yeah, good.
I'll elaborate a little bit more on that and your second question related to that, and then you can maybe handle the next question. I also, I will ignore the fact that I previously worked for the organization that was behind Gears Ratings, so I won't dive into that in too much detail. But I think there's an important acknowledgement of we shouldn't just look at burden as its own topic, in that what's really key is burden matching the value added to the entrepreneur. And so I think as we think about what is the application to SMEs and all of that, as we talk about what is actually decision useful here and valuable, the important component is calibration to make sure that that's valuable, and it needs to include the voices of those who are affected by these decisions in the process. And I think that's the connection to your second question, which is our aim is to develop a universal set of standards for impact accounting. However, we acknowledge that within those universal set of standards, there needs to be contextualization baked into it. And so we don't want to go out there saying there needs to be an impact accounting approach for Uganda that's different from an impact accounting approach for Egypt that's different for Netherlands. We want to say there should be a common approach to impact accounting, and that approach needs to acknowledge the different realities that exist in different places. And just like Seb mentioned, as his commitment as a part of the VTPC, I think it's important for us all to make sure that we are taking those into consideration. We've tried to develop a really globally representative body to advise us. We've also talked about how frequently public comment periods tend to be overly dominated by organizations in the global north, and I think that's something that we need to work on collectively, but also as an organization to create more of that voice for others as well.
Amazing. And there's a public commentary window open right now. Do you want to mention that?
That will be my close.
Okay, you're closing. Amazing. And they will respond to everything? No, we have one question left, right?
Then I'll take the one on the reporting standards and the influence, which fits well because we were very closely engaged with the European reporting standard that was developed. I think a lot of people still don't fully grasp that there is actually a time of change, because once these reporting standards are really, they apply, and for Europe that will mean 50 to 100,000 companies that need to report mandatory on these aspects. That's a blessing in the sky for impact accounting, but also a challenge, because that will mean there's a lot of these physical KPIs, your tons of CO2, your cubic meter of waters, but they are fairly meaningless if you just have them in an account, if you just have them in a reporting standard. You can't make a decision with it. So to some extent, that question of how reporting standards and data availability play a role, I think that will change significantly over the next few years with the reporting standards and the ISSB bringing this to an international level after Europe. And the real key advantage of impact accounting is that you can actually use a methodology, a tested methodology, to use this information that you need to report because it's mandatory anyway. So you can actually use the resources that you need to spend internally anyway, because at least in Europe it's mandatory, and actually make this useful for your internal decision making. And I think this is a message that we need to bring much broader into the whole impact accounting environment, because there's a real benefit in that, because the whole landscape changed. The landscape changed the second that reporting on sustainability with the EFRAGs and the ISSB changed from a nice to have to a mandatory. Mm-hmm. And I think there's a big, big opportunity now for everyone who starts their journey on impact accounting now, instead of waiting a few years and then being last in line.
Great message. I promised that we would finish on time, so I will ask everyone the three questions. Raise your hand. Did you roughly get what impact accounting is?
Hey.
A success.
It's pretty good.
That's not too bad.
Why does it matter? Amazing. How it's done, that was the trickiest. How it's done, more or less? An idea? Well, it's complex, I know. Okay. Tobias did a great job, but in the few minutes we gave him, poor him. But we can keep working on that. It's fine. We don't have to achieve everything at once.
Part two.
Yeah, part two. So look, here in the room we have surely investors, asset owners, managers, foundations, probably corporations, professionals providing services, consultancies, market builders, academia. You have a chance to issue a call to action to everyone in this room. What would you like us as a GSG community, what would you like to happen? I mean, how can we help to you? How can we engage with you?
My first answer is really simple. We want your feedback to inform the methodology itself. We really do take comments during public comment periods very seriously. I feel like sometimes they seem like a black box, and we are actually in the midst of our first public comment period right now for our first publication, and so would love it if you all took a look at it and provided your feedback.
Amazing, thank you. Tobias?
I think I follow on Mr. Wolf earlier this morning. Accounting itself without action is pretty meaningless. So, and I think there are already established ways to put this accounting really into action and show that it makes sense financially, but also environmentally and socially. So I would only hope that more companies engage the sooner, the better, to start this journey, which will take some time to really grasp what this means.
Mm-hmm. Thank you. Andrea?
Specific call to action. So one, for our companies, investors interested in exploring this, or other decision makers and organizations, please definitely reach out. And then secondly, most importantly, for market builders out there, the capacity builders, the consulting firms, the NGOs, the research organizations, academia, that are interested in collaborating in any way in developing of guidance or tailored to your specific region or country, please definitely reach out. And I definitely count with the support of the GSG to help us further expand into emerging markets and make sure that we're addressing the Global South as well.
You will hear much more about that. So thank you all. Engage in the consultations, be early adopters, be advocates, build capacity, educate yourselves to train others. Thank you everyone for coming. I want to thank very especially Renata from my team. She's there and she worked very hard with all of us to make this a success. And we are finalizing on time, and you've been a lovely audiences, very well behaved. You were amazing. You raised your hand. You laughed with the silly jokes. You learned. What else can we ask for? Now keep going, and remember, it's all downhill from here. Bye-bye.